On behalf of the Reserve Bank, a hearty welcome to you all to this dissemination of the monetary policy statement for 2013-14, which we put out a short while ago. Based on an assessment of the current and prospective macroeconomic situation, we've decided to reduce the policy repo rate under the Liquidity Adjustment Facility (LAF) by 25 basis points from 7.5% to 7.25%. Consequently, the reverse repo rate under the LAF, determined with a spread of 100 basis points below the repo rate, gets calibrated to 6.25%. Similarly, the marginal standing facility MSF rate, determined with a spread of 100 basis points above the repo rate, and also the bank rate, stand adjusted to 8.25%. These changes have since come into effect immediately after the announcement. Today's decision to further ease the monetary policy stance was informed by two considerations. First, growth has decelerated continuously and steeply, more than halving from 9.2% in the fourth quarter of year before last, 2010-11, to 4.5% in the third quarter of last year, 2012-13. The Reserve Bank's current assessment is that activity will remain subdued during the first half of this year, with a modest pickup in the second half, subject to appropriate conditions ensuing. The second consideration that went into the policy decision was the inflation outlook. Although headline WPI inflation had eased by March 2013 and came close to the Reserve Bank's tolerance threshold, it is important to note that food price pressures persist and supply constraints are endemic. These could lead to generalization of inflation and strains on the balance of payments. The policy document also spells out the three broad contours of our monetary policy stance. These are, first, to continue to address the accentuated risks to growth. Second, to guard against the risks of inflation pressures re-emerging and adversely impacting inflation expectations, even as corrections in administered prices release suppressed inflation. And third, to appropriately manage liquidity to ensure adequate credit flow to the productive sectors of the economy. As per standard practice, we've also given the following guidance for the period forward. Today's decision to further cut the repo rate carries forward the measures put in place since January last year towards supporting growth in the face of gradual moderation of headline inflation. Nevertheless, it is important to note that recent monetary policy action by itself cannot revive growth. It needs to be supplemented by efforts towards easing the supply bottlenecks, improving governance, and stepping up public investment, alongside continuing commitment to fiscal consolidation. Upside risks to inflation in the near term are still significant in view of sectoral demand-supply imbalances, the ongoing correction in administered prices, and pressures stemming from increases in minimum support prices. In view of this, monetary policy cannot afford to lower its guard against the possibility of resurgence of inflation pressures. Monetary policy will also have to remain alert to the risk on account of the large current account deficit and its financing, which could warrant a swift reversal of the policy stance. Overall, the balance of risks stemming from the Reserve Bank's assessment of the growth inflation dynamic yields little space for further monetary easing. The Reserve Bank will endeavor to actively manage liquidity to reinforce monetary transmission consistent with the growth inflation balance. Our policy decisions have been based on a detailed assessment of the global and domestic macroeconomic situation. Let me comment first on the global outlook. Since the Reserve Bank's last quarter review in January this year, near-term risks in the advanced economies have receded. This improvement, however, is yet to fully transmit to economic activity, which remains sluggish. Risks Shifts in policy implementation and uncertainty about outcomes continue to threaten the prospects of a sustained recovery in advanced economies. Emerging and developing economies are in the process of a multi-speed recovery. However, weak external demand and domestic bottlenecks continue to restrain investment in some of the major emerging economies. Moving on to the domestic economy, with output expansion of only 4.5% in the third quarter of last year, the lowest in 15 quarters, cumulative GDP growth for the period April-December 2012 declined to 5%. This was mainly due to the protracted weakness in industrial activity, aggravated by domestic supply bottlenecks, and slowdown in the services sector, reflecting weak external demand. The CSO put out the advanced estimated GDP growth for last year, 2012-13, of 5%, lower than the Reserve Bank's January 2013 baseline projection of 5.5%. The CSO's lower estimate reflects slower than expected growth in both industry and services. Looking ahead, economic activity during this year is expected to show only a modest improvement over last year, with a pickup likely only in the second half of the year. Agricultural growth could return to trend levels if the monsoon is normal, as recently forecast. The outlook for industrial activity remains subdued because of the pipeline of new investment has dried up and existing projects remain stalled by bottlenecks and implementation gaps. Growth in services and exports may remain sluggish too, given that global growth is unlikely to improve significantly from last year. Accordingly, the Reserve Bank's baseline projection of GDP growth for the current year is 5.7%. Let me now turn to inflation. Headline inflation, as measured by the Wholesale Price Index, WPI, moderated to an average of 7.3% last year, down from 8.9% in the year before. We ended the year with WPI inflation of 6% in March 2013, the lowest in the last 3 years. Even as headline inflation eased, there were upside pressures on food inflation through the year, owing to an unusual spike in vegetable prices early in the year, followed by rising cereal prices. Fuel inflation averaged in double digits during last year, largely reflecting upward revisions in administered prices and the pass-through of high international crude prices to freely priced items. Non-food manufactured products inflation ruled above the comfort level in the first half of last year, but declined in the second half, reflecting easing of input price pressures and erosion of pricing power. Even as WPI inflation eased, retail inflation, as measured by the new Consumer Price Index, averaged 10.2% last year, largely driven by food inflation. In the Reserve Bank's assessment, WPI inflation is expected to be range-bound around 5.5% during the current year. This assessment factors in the domestic demand-supply balance, the outlook for global commodity prices, and the forecast of a normal monsoon. It is critical to consolidate and build on the recent gains in containing inflation. Accordingly, the Reserve Bank will endeavor to condition the evolution of inflation to a level of 5% by March 2014. Let me now turn to liquidity conditions. Liquidity remained under pressure throughout last year because of two factors. First, persistently high government cash balances with the Reserve Bank, and second, elevated incremental credit-to-deposit ratio for much of the year. In order to alleviate liquidity pressures, last year, the Reserve Bank lowered the cash reserve ratio, CRR, cumulatively by 75 basis points, and the statutory liquidity ratio, SLR, by 100 basis points. In addition, we injected liquidity to the tune of 1.5 trillion rupees through open market operations. The Reserve Bank will endeavor to actively and appropriately manage liquidity to ensure adequate credit flow to the productive sectors of the economy and to reinforce monetary transmission consistent with the growth-inflation balance. The macroeconomic outlook for this year, as set out in the policy statement, is subject to a number of risks. Let me briefly address them. First, the biggest risk to the economy stems from the CAD, which last year was historically the highest and well above the sustainable level of 2.5% of GDP as estimated by the Reserve Bank. A large CAD, appreciably above the sustainable level year after year, will put pressure on servicing of external liabilities. Second, even as the large CAD is a risk by itself, its financing exposes the economy to the risk of sudden stop and reversal of capital flows should global liquidity rapidly tighten. Global liquidity situation could quickly tighten for emerging and developing economies, including for India, for two reasons. First, the outlook for advanced economies remains uncertain, and even if there may be no event shocks, there could well be process shocks, which could result in capital outflows from emerging economies. Second, with quantitative easing, advanced economy central banks are in uncharted territory, with considerable uncertainty about the trajectory of recovery and the calibration of QE. The third risk factor is that a sustained revival of growth is not possible without a revival of investment. But investment sentiment remains inhibited, owing to subdued business confidence and dented business profitability. Both borrowers and lenders have become risk-averse. Borrowers have become risk-averse because of governance concerns, delays in approvals, and tighter credit conditions. For lenders, risk aversion stems from the erosion of asset quality, deteriorating cash flow situation of borrowers, eroding their creditworthiness, and heightened risk premiums. The final risk factor is that the effectiveness of monetary policy in bringing down inflation pressures and anchoring inflation expectations could be undermined by supply constraints in the economy, particularly in the food and infrastructure sectors. Without policy efforts to unlock the tightening supply constraints and bring enduring improvements in productivity and competitiveness, growth could weaken even further, and inflationary strains could re-emerge. Since this is the annual policy, as per standard practice, it also includes developmental and regulatory policies. Let me briefly indicate some of the important initiatives in this regard. I will begin with initiatives for further strengthening the regulatory and supervisory framework. We have finalized the prudential guidelines on restructuring of advances by banks and financial institutions based on the Mahapatra Committee recommendations. They will be issued during this month. The unhedged portion of the foreign currency exposure of corporates has been a source of concern. To address this, we have decided to increase the risk weights and provisioning requirements on banks' exposure to corporates on account of corporates' unhedged foreign exposure positions. As indicated in the guidelines for new bank licenses, we are in the process of preparing a discussion paper on the banking structure for India. The discussion paper will cover issues such as consolidation of large-sized banks with a view to having a few global banks, the desirability and practicality of having small localized banks as preferred vehicles for financial inclusion, the need for differentiated licensing regime for investment banks, and conversion of urban cooperative banks into commercial banks. The discussion paper will take into account international experience as well as our domestic situation. Let me now turn to a few initiatives for furthering financial inclusion. The Reserve Bank's website contains FAQs on KYC and other requirements. The Reserve Bank has also made active efforts to disseminate these requirements. However, recent developments, as also the needs of financial inclusion, have made it necessary for us to disseminate the requirements in a more lucid way. We will revise the FAQs accordingly. The Reserve Bank attaches great importance to speedier branch expansion in unbanked rural centers for ensuring seamless rollout of the direct benefit transfer scheme of the government. Towards this end, banks are being advised to front-load the opening of branches in unbanked rural centers over a 3-year cycle, coterminous with their financial inclusion plans. Furthermore, instructions are being issued to banks to open bank accounts for all eligible households. Improving credit delivery to micro and small enterprises is a focus area. In light of the feedback received from stakeholders, we are enhancing the limits to micro and small enterprises for priority sector classification. The statement also contains several initiatives to strengthen the financial market infrastructure. I will mention just two. We felt that there is a need to improve the interface of exporters with banks and financial institutions to cut delays and streamline procedures. Towards this end, we reported earlier that we would constitute a technical committee to study various issues such as availability of credit, transaction costs, insurance, factoring, and other prudential and procedural aspects. The technical committee, chaired by Executive Director Padmanabhan, submitted its report last month. We are examining the recommendations and will put out the report on our website shortly. In a move towards further liberalization, we have decided to allow foreign institutional investors to hedge their currency risk by using exchange-traded currency futures in domestic exchanges. As envisaged in the Reserve Bank's vision document on payment systems in India, we have decided to allow non-bank authorized entities to be part of the payment system infrastructure. Separately, we will prepare a discussion paper for examining the measures to be taken to mitigate and eliminate concentration risk in the payment system infrastructure. Finally, a comment on meeting the growing demand for banknotes and coins in the country. We are streamlining the system of distribution of banknotes and coins and are exploring alternative avenues for the distribution by banks. The mechanism for detection and reporting of counterfeit banknotes is also being improved. To further this, we will shortly introduce a scheme of incentives for banks. I have highlighted only a few of the developmental and regulatory initiatives. There are a host of other initiatives in Part B of the policy document. I urge you to go through the policy document in detail. Let me conclude by summarizing our macroeconomic concerns. Growth slowed much more than anticipated, with both manufacturing and services activity hamstrung by supply bottlenecks and sluggish external demand. Most lead indicators suggest a turnaround this year, albeit at a slow pace. Inflation eased significantly in the fourth quarter of last year, although upside pressures remain both at wholesale and retail levels. The growth inflation outlook indicated in the policy statement is also beset with risks such as the still high twin deficits, the vulnerability of our external sector to sudden stop and reversal of capital flows, inhibited investment sentiment, and tightening supply constraints, particularly in the food and infrastructure sectors. The challenge for the Reserve Bank is to calibrate monetary policy to address these risks and bring inflation down to the tolerance threshold in order to return the economy to a sustainable growth trajectory in the years ahead. Thank you for your attention. Thank you.